Welcome to Hacker Trading. This is Swaminathan. In this video, I want to show you why the Iron Condor is such a popular strategy. So now we are in our advanced series of these videos. So in general, to understand these strategies, you have to go through modules 1 through 5. And once you've understood the spreads very well, all the four, the credit spreads as well as the debit spreads, then you can move into the advanced strategies. And the Iron Condor is actually a very popular strategy. And there are several plus points to the Iron Condor as well as a few negatives. So let's take a look at what an Iron Condor looks like and how we construct it. So if you see Apple's trading today at 575. So if we go into our August series, which is about 51 days away. So in general, you want to give about somewhere between 50 to 60 days to put on an Iron Condor. And the reason is your primary method of making a profit on an Iron Condor is through time decay. And so when you put an Iron Condor, which is about 51 days away to expiry, then you can hold this position for about a month, perhaps even 40 days. If it's going very well, you can hold it for about 40 days. So this is about a 3 to 6 week kind of a trade. And it's also a strategy that's good for working professionals because in general, there are very few adjustments required, which means there's very little monitoring required, unless of course there is a huge move by Apple, and then you'll have to see which way it's moving. But what the Iron Condor is a combination of two spreads. It's a combination of a bear call spread as well as a bull put spread. So let's look at our Iron Condors, and what we'll do is on the bull put side, we're going to construct a bull put spread. So we'll sell a vertical spread on Apple, and if we can come back and look at this, it's at a 510,505, and that's fine. So it's a $5 wide bull put spread. So now what we need to do is come to our bear call side. So which means we go above where Apple is trading. Apple's currently at 575. So our bull put, our short strike was at the 510. So which means it's about $65 away from where Apple is currently trading. And if we try to go a similar distance out on the call side as well, if you see, what we'll need to do is go to about the 625, 630. So let's try the 630 and let's sell a vertical there as well. So what we have now are two vertical spreads. One is a bull put spread and one is a bear call spread. And in an Iron Condor, you're going to receive credit from both your spreads. But the great thing about the Iron Condor is that even though you have two credit spreads, your risk actually gets lowered. And that's because if you look at the risk profile, you'll understand what it is. So this is an Iron Condor on Apple, which we've just put together. So basically what we are saying in the Iron Condor is that as long as Apple stays between our short strike prices, which is at 510 and at the 625, as long as Apple stays in between this range, then we are going to make a full profit of about $1,600. So if you think about it, what ends up happening is this is a combination of two spreads. So on this side we have the bull put spread, and on this side we have the bear call spread. So the bull put spread is bullish and the bear call spread is bearish. So if you look at the net delta on this position, it's almost delta neutral. So it's the delta is -5, so which is as close to delta neutral as you're going to get. But the good thing is you're getting a credit from this spread and you're getting a credit from this spread, but your risk is not doubled. In fact, your risk reduces. And that's because Apple, which is right now at 575, can only be at one spot. It might come down or it might go up, but it cannot do both at the same time. So what ends up happening is one side of your spread is an automatic winner. So when one side of your spread is an automatic winner, your broker takes that into consideration, and what he does is he reduces your buying power. So for example, if we took off the bull put spread, you can see that your margin goes up. So if you just had one of those spreads, your margin is 4,100. And now let me take off the bear call, and you can see again your margin goes up to 4,250. But when you put both of these on, your margin actually reduces. Not only does your margin reduce, but your profit potential doubles because you're getting credit from this spread as well as credit from this spread. So this is, you can see why this is a very popular strategy, because it's non-directional. You don't care whether Apple goes up or down. As long as it stays in this range, then your iron condor is going to make a full profit. Of course, now the question is, how long are you going to hold this trade? And will you hold it to expiry, or will you take it off sometime in the middle? So let's quickly see what that means. So today it's June 27th. Now we know that the primary method of making a profit is from time decay. So on a daily basis, you're going to make $20. Now, this might not seem like much, but it's an issue of scaling. And you could put in 50 contracts. You could even increase the width of the strike prices. You can do a lot of things. What we want to do here is to just try to understand the concept. So if we make $20 a day on time decay, let's see what happens. And on Thinkorswim, you can simulate your trade. So here, today's current date is June 27th. So let's see what happens if we move the date by about a week, say to July 4th. Now, if we move it up to July 4th, you can see that your profit and loss has become, your P&L has become 164. And now your time decay has increased to about $25 a day, because as you approach expiry, options are going to lose more and more value each day. So time decay is exponential when options are approaching expiry. And now you can also see that the white line has moved ever so slightly into the profit zone. And that's exactly what your iron condor is. So as long as Apple's trading somewhere in the middle here, you're going to see this white line move up towards the red line, because the white line represents your profit for today, and the red line represents your profit and loss on the day of expiry. So let's move this ahead by another week, and now you'll see the white line's gone up again some more, and there's been more time decay. Now your time decay is about $29 a day, and your total profit on this position is about $355. So let's move it further by one more week to July 18th, and you can see that you have a profit of about $583 now. Your time decay is $35. Time decay is increasing it at an exponential rate at this point. So then we move it for another week. Then we would have moved it, we would have kept this position for 4 weeks now, and you can see that you have a profit of $855. And you can see the white line is nicely in the profit zone, and if you put your cursor exactly there, that's what your total profit is going to show. And now your time decay is $41. But at this point, you have to think, you've kept this trade on for 1 month. You have a profit of $850, and your total investment into this position was $3,300. So we're looking at an approximately 25% return right here in 1 month. So, on an annualized basis, obviously that's a huge number, but if you can get 25% return in 1 month, that's a good trade. So, at this point, you may not want to risk any huge moves that Apple might make, because bear in mind that your position will get into trouble only if Apple approaches one of these short strikes. So if Apple moves too far on the upside or too far on the downside, that's when your iron condor gets into trouble. And that's when you'll have to adjust it. When I say it gets into trouble, it doesn't mean you don't have any options. This is not a stock. This is the options world, where you always have options, and that's exactly why they're called options. So, we'll have a number of alternatives to work with, but right now, if you have a profit of about 25%, you can take this trade off and move on to the next month. So you can keep doing this on a monthly basis. So that's what an iron condor looks like. We cover the iron condor in actually 2 or 3 courses in our advanced and our mastery series. There we put a complete trade on, we monitor the trade. It's a live trade. So you'll see live examples of iron condor in action, and we keep the trade on for about 3 to 4 weeks and take it off. And that's all in modules 6 and 7. So hopefully you've enjoyed this. Please let me know if you have any questions, info@hackertrading.com, or you can leave us a comment on this page itself. Thank you.